Hey everybody, welcome to our webinar today, Adapt or Be Outpaced, the tech imperative for retail's mid-market. I'm Greg Busick from IHL. Thanks so much for being with us today. I'm going to introduce my cohorts. First of all, Andy Zanger at CDW, who's joining us today, and gracefully these guys are the sponsors of today's webinar to make this content available to you. And then, as always, we have Lee Holman with us. First of all, please tell us where you're from. On your right side, you're going to see a chat area. Go ahead and click on that, and that's going to show you a ton of people from all over the country. Tell us where you're from. Tell us who your favorite sports team. Are you a pro football fan? Are you a college football fan? Man, we've got some big games this week. We got the Ducks versus Penn State, Alabama, Georgia, Ohio State playing at Washington. So I'm excited about that one. But tell us where you're from. Let's get engagement going through the content. Just tell us who you are, where you're from. Next, I'm happy to announce the availability of what we call the IHL AI Analyst. One of the challenges that's been a troubling issue for literally everybody that is a startup or a small company or a product manager or a business development manager who doesn't have access to advisory services is, how do I get access to an analyst to talk to them? How do I run things by an analyst? I mean, it might be, hey, I'm going to call on this particular retailer and I need to get some tips on what's going on there. What do they use? Who's the right people I need to talk to there? We've announced this new AI analyst. This is a way to get 30 years of my experience. This includes all of our webinars, all of our white papers, our research papers there, as well as some of the stuff that's behind the firewall, such as the Sophia content. So if you need 300 technologies, what's there? Our IT spending model. You need to know what the forecast is for this in retail by a region. You can pull that information here with this IHL analyst. But this has just enough freedom as well to where real-time news, as it's coming down, you can get comments on that. And unlike ChatGPT or Claude or some of these other things that are 2 to 3 years behind, unless you do deep research for each query, this has our latest data, even as of today. Today's research is actually in the model and it's trained. So this is a fine-tuned model that's available. You can get content here, you can get writings, you can get help with presentation outlines, you can get all of that stuff, and it's filtered through my 32 years of experience in the industry, as well as the research from Lee and Jerry and everybody else. So we're excited about that. I hope you are too. And that's a way to just get access to thousands of you that are in our audience that don't have access to our services today, other than sitting on a webinar from time to time. So with that, let's get into the data. And as always, I like to start wide and narrow ourselves down into what's really going on in the world. So this is the government data on inflation. And if you followed us at any length of time, you know that it's been our view that it's been quite a while that into where we have to get to for inflation. And the latest data for August, we're at the half twos are at 1.7%. And then if you strip out this made up number, which is 40% of the shelter number, literally we are at 1.3% inflation rate for what people need to do on a monthly or daily basis. So in our view, the Fed is probably 4 to 5 months late in lowering interest rates. And that's creating a drag on the economy in many different ways. As always, our favorite indicator is Truflation. Truflation is like a Nielsen ratings of what's going on from market basket analysis. It's real time. It's changing every single day. With Truflation, they have us at 2.05%. We're starting to see a little bit of the tariff impact hitting certain categories, as well as a jump where we had with gas prices due to the Labor Day holiday for things there. So let's look a little deeper there at gas prices. Gas prices are still higher than where they are, but they're coming down fairly quickly now after that Labor Day holiday. The one piece I would want to bring up is we are literally, diesel is higher than we were a year ago, which is really odd. And I don't have a good explanation for that. 4 months ago, we were about 50 cents lower. But the key thing to remember is this filters throughout retail completely from an inflation standpoint, as well as a freedom of cash for consumers. As gas prices go down, every penny sustained is $2 billion more that can be spent on other things. So this is where we're at, $3.16 a gallon overall right now nationally as of this week. What's driving the inflation is really insurance rates, not only auto insurance rates, which are up 55%, but also your homeowners insurance rates around the world, around the country, excuse me. The debt is what's fueling retail gains. You're going to see a dichotomy in this data. The economic data makes no sense for retail to be up. All the sentiment is negative. I'm struggling to put positive news in here because some of this data is so depressing right now because we're in this period of austerity and consumers are dealing with it right now. We've got some positive things on the horizon in 2026 when the SALT deduction, people start getting returns and the benefits of the SALT deduction, which is your state and local tax deduction. So for homeowners, which generally are the higher 40 to 50% of the population, there are some windfalls coming on tax returns next year that I don't think are fully baked into all of these numbers yet. So everything just seems negative as we have tariffs, as we have inflation, as we have higher insurance rates, et cetera, and then issues with the jobless side of things. So as you can see here, and I don't know if it does show up, you get a much higher level of consumer debt and credit card debt that we are seeing. And this is really what's driving the retail therapy, as I like to call it right now. If you look down to the other things, the loans, the number of other loans is pretty well flat in terms of the number of those loans. What is different, though, is just the rapid rate of those things going up. We now have auto loans that surpassed student loans, which we haven't seen since right after the Great Reset or the financial recession that we had in the late 2008, 2009, 2010 period. So the big bubble, if I was going to say a bubble, everything on the news, CNBC right now is, are we in an AI bubble? Maybe from an investing standpoint, we are. We are certainly not in an impact of AI bubble. We are still first inning in all of this stuff. We are, however, starting to see a bubble when it comes to the value of college education. That has literally been thrown on its head in the last year with things. The cost of college has gone up 700%. In the last 40 years, the overall CPI is up about 200%. So between those things, we've got this massive issue where AI and then slowdown in hiring of jobs. So the job market is strong from a keeping your job standpoint. It's very poor from a finding a job standpoint, particularly for new grads. What's not being reported because they're not part of the statistics is new grad unemployment right now, which underemployment for new grads is running about 60% today. It's really devastating out there and really, really tough for new grads to find jobs because think of it, hey, what does AI do well? AI does book smarts well. What does a new grad have? He's got book smarts, but not the experience. And so it's adding value to that experience, but it's getting much more difficult for those new grads to find jobs, particularly in those things that were in high demand, STEM and computer engineering, computer coding. That part has been sort of flipped on its head with the rise of AI and the promise of that. As we mentioned, housing is such a huge part of retail. We've got some good housing news after seeing things being really, really rough in housing. It takes 48% of the median income right now to own a home there, which is the highest it's ever been. The gap between affordability to buying and the actual income is 57% higher. For things, the level of income you need to own a home is significantly higher than where it was prior to the pandemic. And the other thing is that impacts retail is related to first-time home buyers, because first-time home buyers have to buy everything. And this is the lowest it's ever been as a result of that. Now, as I mentioned, we're going to get into some good news. This last data point of negative news is just what's happening to men in our country. I don't want to get into the socioeconomic piece, but just the economic piece, because we've seen a significant drop in the number of 30-year-olds that are both married and homeowners. The reason for that is provides more stability in the economy. But once again, as homeowners, you're buying everything new for the first time, and that drives retail spends. We've got issues socially with this, but we also have issues economically with this that impact retail. So I alluded to this, some good news on housing. Interest rates came down. The Fed dropped the rate a quarter point. That's not enough to really do anything or move the markets. but the 30-year fixed rate is down to 6.125 at the lowest right now, which is significantly down from where we were a year ago. Overall, about $200 savings each month, and refinance rates are up 70%. Now, the government data said new home sales for August were up almost 21% there. Talking to the builders, though, on CNBC, they said right direction, order of magnitude off of what they think is really going on there. And this just gets to the crux of the government data not being as reliable as other sources of data out there. Now, just before we came on air today, they announced that existing home sales were flat, essentially flat for August. Those are the closings in August of existing home sales. So we're really talking about July data, but they're flat there. So we've got some positive news, and then it's like you get, two steps forward, one step back as all these different data pieces come into that. But this is critical for retail sales, particularly when you get to hard goods, which has struggled for the year there. Jobless claims came out this morning, tumbled to this is the main headline on CNBC. They 218 versus expectations of 235. Take it with a grain of salt. This is the same stuff that came out where they took 900,000 jobs away when they revised it in six. So this is going to help the markets a little bit today, but it also does say, well, maybe the Fed's not going to lower rates as fast as they should. And like I said, we've got this brewing issue with college graduates not getting jobs that is starting to become a real problem in our society and in our economy right now. And we've got to figure that piece out. And all of that flows into what's going on with retail. Here, the University of Michigan consumer sentiment, I don't know if it's ever been this pessimistic. Right now, we're going through this austerity with tariffs and higher prices and inflation and all these changes with administrations here, and none of the good stuff is really happening unless you know enough about taxes to dramatically lower your payroll taxes for things there. So the consumer expectations, consumer sentiment is extremely low right now in this survey. If you look at it over time, it's a little better than where it was at the bottom, which was in April, when tariffs were just announced, but it's nowhere near obviously where we were pre-pandemic. Basically, the overriding mood is negative, and that's why I keep getting back to every bit of this news is negative. This is finding a job for those that don't have a job. So the number, the likely, slightly or not at all likely of finding a job to meet their needs there specifically is a negative out there for those that are unemployed, most certainly. This was another data point from the Wall Street Journal. This is down significantly in terms of finding a good chance of improving the standard of living. We've got to get to some positive news for things, and I think we're about 6 to 8 months away from that. If the Supreme Court upholds the tariffs, I mean, that's the big one, is can we get some certainty on that so that people can move forward? That helps a great deal. But if the Supreme Court throws that out, now we're back into a free-for-all when it comes to everything there. Wage growth for job switchers is now down to the same as staying in your job, which is if you look at that, the times that those have been really close have been times that have been austerity. So you look at the financial crisis in 2010, you go back to the 2004 time, 2001 to 2004 timeframe, where those were together. Other times, job switchers generally would get more money. That has come down there. What we're seeing in jobs is companies not necessarily laying off, with the exception of tech. The tech jobs have seen layoffs, but outside of that, the other industries is pretty much stable payroll, stable things, and the job switching has not occurred. Health insurance premiums continue to skyrocket. That is also adding pressure to things. When you think of things 6 months ago, from now, I want to try to get some good news. The average family and the average family home, there's probably a potential for up to $5,000 to $10,000 more money in their pockets and lower taxes. The extension of the 2016 tax cuts also is going to affect people when they get their tax returns and they do their taxes for 2025. That is just not reflected anywhere in data out there right now. And just so to show there is hope in the future here for a better economy. And here's one of those charts. It's just the expectation of GDP. And this is where AI starts to really come into play, because The Atlanta Fed estimate is now over 3%. We were last quarter, we were at 3.9% growth in GDP. There was I think there were not 3.84, something like that, 3.9. It was just on. Just got revised for GDP. The belief is that AI, if you talk to the people that are pushing AI the hardest, is that we may get to a 10% GDP when AI is fully baked there into the economy. But let's face it, this is the changes that have to occur in companies to deploy AI are tough for existing companies. It's far easier to start from scratch and build a company than it is to take another one. I've been trying to find the right metaphor. I'm almost thinking it's like, scoring from the 2-yard line versus scoring from the 10-yard line in a football game, or changing a battleship to an aircraft carrier. There is major transitions that have to occur in companies to fully leverage AI appropriately. And some of the initial data we are seeing, unfortunately, is that the job loss will occur before the job change does, and the job growth from AI tools there, that even in retail, the initial data we're seeing is the executive level seems to think we'll have fewer people working in the supply chain, in stores, et cetera, in the next 2 years from where we are today. The people working in those positions think we'll have more people working in those positions with the growth of the company. So there's this dichotomy that's not being explained properly out there. AI is clearly having an impact. Last webinar, we talked about the misapplication of the MIT study, where people said 95% of companies are not getting return for their AI expenditures. There's a number of things that were misread in that study by the Fortune magazine headline writer. But the most significant is literally anything over a 6-month ROI counts as a failure. And that ROI is $1 million return in 6 months. They talked to 52 companies. That's their data. So their data is their data. It's just how it was construed in the press and what people believe out there. It's totally wrong. The Fed is expecting GDP rates to improve. The market is expecting the funds rates to probably drop further than they actually are when we have this conflicting jobs and inflation data that is occurring from the government data. So there's a difference in expectations in the stock market. This is the expectations of where we will be at the end of 2026. This is what the market thinks that we will have. So if this does occur, if we even get to midway, like the June number is our end number, that is a boom for investment in retail, in technology, in housing, everything. That becomes a massive help to productivity and increased sales. So let's hope these guys are right in their expectation, and the Fed is wrong with things there. Consumer sentiment stronger with the highest incomes. However, we did see a significant drop here since the tariffs were put into play here, and most specifically in the last couple of months, particularly with a drop in consumer sentiment. Still over 100, which is the baseline. If you have a job and you're higher income, generally are continuing to spend and feel pretty good about things. Maybe not socially. Obviously, we've had lots of social issues that have happened this last several weeks. But overall, that is the group that is driving retail spend right now, and it's still over where we've been historically. So that's good, and that's what's keeping things going. So after all of that negative news, you would think retail was down, and retail is not down. Retail is actually up over 6.5% for the year in core retail sales, or total retail sales and core retail sales there. The only way to explain it is retail therapy. That's the only way that I can explain it. It's the higher incomes that are driving that. As we look at this data, so that data that I showed you is real credit card data on 9 billion transactions, where the government data is a survey of about 40% of institutions. The credit card data, which is on the right, which is even more positive than what the government data is growth year to year on credit card data, and it's even stronger. People just they're buying things. They're continuing to buy things. So where are we inflation adjusted? These are the government numbers. We're up 1.8% for the year. Inflation adjusted on the government numbers, still positive with the exception of department stores and especially hard goods. I will tell you, department stores and especially soft goods, the inflation there has been flat to negative in some cases. And we've seen gas prices lower generally in convenience and gas, which has opened up the opportunity for people to travel more that way. The hard goods, guys, is completely impacted by housing. If housing picks up, that fixes itself quite a bit. And so when we look at that, this also shows that the top 10% of the incomes are driving the vast majority of expenditures. Those lower incomes, that under $50,000 incomes for families, are really hurting out there. I can't say that enough. They're really hurting with the inflation and everything else. And a lot of these changes that are going to be positive for homeowners don't impact them. And there's some really tough situations there. So the big not having taxes on tips will be a benefit in those income levels, but there's a bifurcation that has happened between haves and have-nots in our economy, which we've seen for years, but continues to get worse. And this is something that's not political. It's gone across spectrum. It's been this way through the last 5 administrations, really 6 administrations, where the rich get richer and we move. The good news is people are moving up lateral in their income. So more people have gone into the middle to upper incomes. But those that are stuck at the bottom, at the lower levels, are really hurt right now economically. And there's no way other to put that. That's why you see the dollar stores in particular struggling out there, is because their core clientele is really hurting and they're cutting back significantly. All right. And then there's this other piece of things when it comes to dining out. We have seen such an explosion. So this is part of the retail therapy, I think, as well. We've seen 40 years ago, if you ate out, you ate at a restaurant. 95% of meals were consumed at a restaurant. Today, only 25% is dine-in. 75% of meals are eaten off that campus. So when you're thinking about solutions for that, we can't be store first. Solutions there, not only in retail overall, as we're going to get into the study now, but you can't be that way certainly for restaurants. You've got to think e-commerce first when it comes to building your solutions for this environment, and certainly multi-channel as we do it. So that leads us to our study, an introduction, adapt or be outpaced, the tech imperative for the retail's mid-market. We surveyed 300 retailers in this space that represented, I think, something like 600 different brands potentially. So what mid-market was over 10 million in size, lower than 2 billion in size of annual revenue. So this data is different in the sense that it's a quick targeted group, a much smaller group than overall there. But our definitions are the same. Leaders, in our view, are 10% sales growth in 2024. Laggards were flat or negative. Same with profit, 10% profit growth there. And that's important to keep in mind as we go through this data. The profit leaders, or the sales winners, are growing their IT spend at a level 4 times that of laggards. The best metaphor, I was thinking about this morning, is you're in a football game. Everything comes back to football. You're in a football game, and one team scores touchdowns, the other one scores field goals, and they don't even get a field goal every time. That's what's happening. And we're seeing a massive change and a massive adoption of certain technologies, and that's starting to play out in a big way financially as we go through this data. But keep in mind, as I mentioned, only 51% of I believe it's 51% of retail sales in this sector are the traditional walk-in sales. 84% of the revenues have some sort of store component in fulfilling that order. When we look at specific technologies in this group, on the left side, you're going to see a number that says, what percentage of people that have deployed this said they got positive returns for this, anything positive on this. On the right side is those that saw a 10% return or better for that technology. So you see digital signage, 90% of the people that have deployed digital signage received a positive return by doing it. 32% got a return that was greater than 10%. Self-checkout, those numbers are a little higher. When it comes to getting a 10% return. Obviously, the theft concerns has been a problem here in recent years. Electronic shelf labels, this is rather new to this particular sector, but I think part of the issue with them with electronic shelf labels that wouldn't be higher is the fact that it hasn't been long enough to see that to see those positive results. Mobile POS for associates, 84% positive return, 42% significant positive return there. And then consumer mobile checkout. Once again, we enter into a potential theft situation here, but removing that friction and allowing customers to check out with their phone has proven consistently to be a very, very positive thing for retailers if you're able to do that. And with that, I'm going to take a break and turn it over to Andy to talk about CDW.
Well, thanks, Greg. Certainly appreciate that and appreciate the partnership of IHL as you provide tremendous value to our organization. So we always appreciate that. And for those of you that are not familiar with CDW, we are a global systems integrator serving more than 250,000 customers in 140 countries. We've been in business for more than 40 years and are currently ranked 166 on the Fortune 500. And with over 1,000 partners in our network, we're in a unique position to provide full stack solutions and services to our clients, helping them in every step of their journey, from ideation to design, procurement, implementation, and ongoing maintenance and management for their software and hardware stacks, and of course, for the services that support their business and their needs. Our retail team in particular has been hired directly out of the retail industry with former directors and VPs of IT from some amazing national and global brands, which we believe puts us in a unique position as well to truly understand the needs of our clients. Because our team has been in the roles that many of our clients are in today, they have faced many of the same challenges and can truly understand the unique intricacies of the industry. And if we move forward to the next slide, Greg, our team spends a lot of time meeting both with our partners. We mentioned previously on the last slide that we have over 1,000 partners. And on the screen, you're just seeing a handful of some of our partners that we work very closely with in the retail space. And we meet with them regularly to collaborate on how we can help move the retail industry forward and find new ways that technology can be used for brands as a competitive advantage. And we also spend a lot of time with NRF and the Retail Solutions Providers Association, and of course with analysts such as IHL, to make sure we're staying in tune with what's happening in the retail industry and where we're going next. And so our team ultimately meets regularly with our clients about talking about things such as improving the customer experience, increasing operational efficiencies, and reducing risk. And, we are, as we mentioned, able to help our clients across all areas of their business. So I won't talk about all of those areas, but I do think, a few things that are not shockingly coming up quite a bit are, around AI. We're hearing a lot about how IT is being pressured by the business to implement AI. And so we speak with them a lot about how they should be thinking about AI and how they can be approaching it, making sure that, we're starting with a business outcome that they're trying to solve for and their experience they're looking to achieve for their clients or store associates, and not starting with the technology and getting caught up in that, because you're far less likely to achieve your true ROI potential if you're starting with the technology as opposed to the business outcome you're trying to solve for. The other thing that we're making sure is front of mind for retailers is making sure they really have a solid foundation for their jumping fully in on AI, as we all know that everyone is trying to figure out how to leverage it. But that's both with their data structure as well as the infrastructure, that's needed to support it. So CDW works with our clients on AI readiness assessments and helping them understand where they are in the journey and what's needed to go to the next step, helping perform services to make sure that their data is structured in proper ways, and of course having that infrastructure to help run all of this, and the actual services, of course, that are needed to design and implement the AI solutions themselves, as well as we have some amazing engineering talent on staff. Getting your data in order is also hugely important as retailers are trying to understand their customers better and also continuing to improve their customer checkout experience, looking at ways of implementing unified commerce, and really having that data aligned properly is key. The last thing I want to touch on, Greg, that I think maybe not focused on enough these days. I know that, when we've spoken in the past that, it seems as though not enough retailers are super focused on the impact of the Windows 11 migration and end of life that's coming up. And I know that you've done some research on that. If I'm not mistaken, the majority of retailers that you spoke to, we're actually not planning on having those upgrades done in time
In time.
for the end of life support.
Yeah, it's quite scary, to be honest with you. The initial data we're getting from our annual study we do with Chain Store Age, that there is a significant percentage of retailers that are both not paying for the extended service or doing the upgrades there. And I think I want to say it's somewhere in the 10 to 15% range from the initial look at the data that I saw.
Yeah, and to me, that's extremely concerning. I think it's something that needs to really be looked at because as we approach the holiday season, we're obviously now in that time where retailers are not going to be able to do a lot of those upgrades if they haven't done them yet or don't get them done pretty quickly, with going down into code freezes and not making any major changes in their environment for the peak season. But as we've seen in previous years, this is probably the bad actors are probably salivating right now because they know that this is happening and they're going to be trying to exploit the lack of software and security updates that are taking place. And retailers are at risk of having those bad actors plant, some of that malware and bad code out there now so that they can activate it in the peak of holiday season and really maximize the amount of information they're able to capture, and then that just spells disaster for many brands and potentially a lot of bad press and loss of customers if this isn't addressed. So we are working quite a bit with our clients on making sure those upgrades are taken care of. And if not, do they have a plan in place for maintaining those security updates until after the holiday season's over? And so we have a very mature security practice that's working with our clients on strategies for overall security posture, but also making sure that they have some cyber resiliency plans in place as well, and just really looking at their securing their customer data. But overall, Greg, really excited about the research that you've done here, and can't thank you enough for the partnership.
Yeah, thank you, Andy, and appreciate it. You keep our lights on. Appreciate you guys and all that you do for IHL and the industry. So thank you. Okay, guys, so let's get into this study specifically. This is a breakout of things related to what size of retailer that was involved. So you'll see we get about 23% that were over $1 billion there, another 36% there that are between 250 and $1 billion, and then about 41% are in the lower to mid-range side of things there. I see Beth has thrown into the chat the link to the report and the slides. You can get access to those there to start that process if you'd like. And with that, I'll get more into this to the respondents in the survey. So what verticals here? So we had a lot of hard goods, not surprising since it's such a wide segment. Grocery, though, was heavy participants in this, especially soft goods, et cetera. So you could see the spread of things. Only about 6% were convenience and gas in this study because they tend to be very, very large or very, very small when it comes to convenience and gas. See similar, the sweet spots for specialty store is right in this area. I think what was fascinating, though, is having 37% being grocery there, or if you add it together with mass merchants and convenience, you're looking at over 50% would be in this, what we call food, drug, convenience, mass merchants, the FDCM, or fast moving consumer goods side of the study. So that gives you the background of who the audience was that participated in this data. And what really came up to place is there is a huge difference of what's happening in this marketplace, just like we see with the largest retailers there when it comes to tech adoption and how fast they're applying different technologies. And we're going to talk about the specific ones that are moving the needle right now. Only 25% of mid-market retailers actually possess what they would call strong in-house technical expertise. So they need to rely on a number of partners, including the vendors that are selling them items. And we're going to show some weird things in the data that you wouldn't necessarily see normally in a study, but it shows that hey, there is real value in these partnerships long term for ROI for these solutions. And this just shows you the breakout further for that. About 53% have some technical experience, but they rely a lot on the partners. And then 22% all rely almost completely on the partners and system integrators for things there. Approach to tech adoption, only about 6% would call themselves early adopters, and 21% fast followers, waiting for that technology to show proven ROI before they deploy it. And then there are others that are even more conservative when they deploy technology. We're going to show some things that show there is a sweet spot for the greatest results when it comes to adopting technology, and it's not what you would think. Although the sales leaders, the people that are bleeding edge here, are 482% more likely to be early adopters of technology than average, that it comes into being self-fulfilling. So the fact that those early adopters tend to have more in-house IT, and so they're far more likely to take new technology, play with that technology, and then roll that technology out. When we look at everything about this, I mentioned earlier, 51% is a traditional store transaction. The rest of it is some sort of e-commerce transaction that is involved. And thus, that store, if you think of it as only a walk-in fulfillment place, you're missing out in terms of all the different opportunities for solution at the store level. The budget difference between these categories of early adopters and fast followers is a huge difference. The early adopters have 52% of their IT budget available for innovative technologies, compared to the laggard down at the bottom here, where you're seeing it is at 24%. Okay, so more than double the amount of budget for innovation. So they're not only spending more each year, but more of their budget each year is going to new technologies. And so this just becomes a rapid race of where these early adopters and fast followers are just running away from things. But I think it's interesting that the fast followers and the careful evaluators are about the same. There. In their case, 54% of their IT budget goes to keeping the lights on with the existing systems, but they're significantly higher than the conservatives or the laggards, even though they're lower than the early adopters. And one of the data points that was kind of interesting is the early adopters, they almost take a venture capital approach to technology in a way. It's like, I don't have to hit all of them, or stock picking maybe. I don't have to hit all of them to be home runs. I just have to hit enough of them to where I get a good return from that technology. Where the fast followers are saying, okay, let's look at what's really happening with this technology and let's test it a little bit more and see if there's an ROI here before we go to start deploy. Complexity of solutions is a big drag on what's going on. So the simpler, obviously, you can make the solution, the better that your opportunity to sell that within the retail environment, and particularly these guys, because they don't have that in-house thing. So a lot of these agentic AI solutions where you got to build your own, some of that stuff's still a little bit too complex for a lot of retailers in this marketplace. So you've got to keep that sort of thing simple. It was universal in the study that technology improves their operational efficiency. 98% feel that way. And that is a powerful thing. So if you read the press on AI in particular right now, first of all, you got to throw into the fact that who's disrupted more than anybody else? Journalists from AI. And so pretty much anything that goes out there journalistically is often negative about AI and picks up on anything negative there. Here we are with a study when it comes to all kinds of technologies. 98% of the people in there says it improves their efficiency, their operational efficiency for things there. But I alluded to this earlier. It's better to be a fast follower, than it is to be first if you're thinking about technology being able to return an ROI within 12 to 18 months. The fast followers, the people that aren't first, are 191% more likely than average to agree that technology delivers ROI within 12 to 18 months. But the early adopters are 300% more likely to strongly disagree with that statement. And this, once again, gets to this venture capital side of things. Hey, we're in a technology battle if we're competing with Amazon and the Walmarts of the world. So we have to invest in these technologies. We cannot wait. But if they hit, we get some big returns, just like that venture capitalist might get here. So this was one of those things where it's like, okay, on the one hand, I get it. The followers are more likely to see benefits. What I didn't really realize is that the adopters disagree with the ROI. So they take almost a skunkworks mentality when it comes to technology, even faster than the fast follower. So if you're looking for return, if you're looking for consistent return, being a fast follower or even a high conservative is actually better financially in our research than being the early adopter for things there. As well, it leads to higher profits. The early adopters had 83% higher than than average profits. The fast followers had 31% higher than average profits. So why do you do this technology faster? So you can get that more profitability faster. So, but once again, it's that on that individual technology side of things, you may miss on that technology, but if you get one that hits, it has a dramatic impact on the financial viability and the financial success of the retailers there. So if you look at the early adopters, 83% higher sales growth, 61% higher profit growth in 2025. But if you look at the fast followers, lower sales growth, higher profit growth, because they're focused more on return. A really interesting angle in this study. So what are the barriers? What's keeping people from doing things? It's that uncertainty about ROI and then the complexity, as we've already mentioned those two things. The one that pops up next, those data security risks, and we're going to have a little bit, you would think these early adopters would be least concerned with the security stuff with what they're doing, and it's actually the other way around. They've actually built their way that is security first. Budgets we have in here, customer resistance to technology, the staff training and change management, that cannot be overemphasized. It is a big problem, particularly when you talk about AI products going into the retail environment. As we've seen in other research, the acceptance of AI is very much dependent on how financially the company is doing. If the company is performing well, AI is viewed as an enhancement, and it's something that's going to be a force multiplier to help us do good. If business is doing bad, AI is going to take my job, and I don't like it. So that is a major issue with regards to that particular technology. But that staff training and change management, you put in iPads, and if come to find out they're not being used at the store level, that staff training and change management is a huge part of any technology that's in play. So as I mentioned, you would think the sales growth leaders or the early adopters would be less concerned about privacy. Actually, it's the exact opposite. The sales growth leaders are 9 times more likely to cite customer privacy concerns as a key barrier to adopting any new innovative technologies. They are very, very super hyper concerned about a breach or anything that could impact their customer service when it comes to adopting new technologies. The non-negotiable, as I mentioned, the profit leaders are 58% more likely to say ease of implementation is critical. We can lose a lot of the benefits by just having it delayed in the rollout or in the use or the staff training there. So that ease of implementation is critical, and most critical to the people that are growing their profits the most for things. So if you're taking notes, that means the profit leaders, the people that are making the most money or making the most profit, are fast followers in technology, not necessarily the earliest, and they're most focused on ease of implementation as a part of what they're doing. So when we look at the next 2 years for deployment of technology, this is the percentage that said they're going to have deployed these technologies in total. They either have it or deployed it in the next 2 years. These are the top ones. So AI for personalized experiences on sales in particular. Tapestry seen a 3 to 5% increase in sales through personalized emails there. I know Ulta has seen I want to say it's a 3 to 5 point uptick. I'm sorry, 5%. That data point is 95% customer retention rate when they have used personalization as part of the sales process. So it's pretty huge for that. Demand forecasting, everybody's trying to figure out what to have on their shelves. Certainly our last webinar and inventory distortion had all of that information in there. One that is growing and becoming more and more important is 5G enabled store experiences, whether that's a LAN backup, another LAN or WAN to the store with all these IoT devices, or whether it's something that's completely separate from the network. And it's just providing the consumers with access to their network at the store level. Those are seeing major enhancements there. The automated inventory management, particularly in grocery, when you're dealing with computer-aided ordering, is seeing huge adoption. This is particularly true now at a second tier where it's a vendor-managed inventory. So it's not just the stuff that the retailer is doing, but the vendor-managed inventory and making sure that is compliant to space planning is a huge situation right now in retail. And we've got a bunch of data coming out for that in the next 30 to 90 days or 60 days with 2 different studies that we'll be releasing for that. Blockchain is growing in the use of that for transparency and tracking. Computer vision, we're going to talk a little bit more in a second, but what's happening now more than anything else is robots in the store, particularly in those fast-moving consumer goods, the large format stores, just getting to accuracy on that data. Last one here, RFID and computer vision. I wanted to dig into this further because RFID didn't show up on that table. 85% of the people deploying RFID in our study were getting positive return. The sales winners are 160 times more likely than the laggards to have deployed RFID. It is the defining separator technology that we have right now in the industry. Before that, it was mobile devices for managers that were the big differentiator back in the late 2000s, first decade of the 2000s. But very, very much so, big impact in profitability. And RFID hits so many different areas. It's not only real-time inventory, but when you think of all those e-commerce delivery options, ship from store, local delivery, et cetera, knowing where that item is, whether you have it, is critically important to the profitability of the company. Now we're seeing computer vision rise huge, 8% saying a positive return. The sales winners are 59 times more likely to see positive results, and they're 88 times more likely to have seen significant higher results than others with using other technologies by using computer visions. Very, very strong data for those two technologies in particular. We're going to see rapid advancement continuing for that. As we mentioned, the agreement that tech provides a competitive advantage, this is one of those things that pops out that you say, is this real? It is true. The smallest retailers, the 10 to the 250, are 60% more likely to strongly agree that tech provides a competitive advantage, whereas the largest of retailers are more likely to disagree with it for that thing. And part of that is the scale. I was doing a presentation last week with a major let's say mass merchant, and he's like saying, all this is great, but I've got thousands upon thousands of stores I got to roll this out to. Where am I going to get the capital to do that with a limited IT budget type of thing? And it was a very impressive statement, and it's something you got to realize. It's like, just because it's a positive ROI doesn't mean you get immediate approval when you're a large retailer there. But also that complexity of that to roll out to that many stores and being consistent across that stores to get the promised return is a bit more challenging for the large retailers, whereas for the smaller retailers, you can be more dictatorial about things and have a stronger culture and get things rolled out much faster. So it's really a fascinating thing. So most critical factors on data and tech adoptions, the data security and privacy came out number 1, the customer acceptance number 2, scalability 3, vendor reliability 4, and then proven ROI was actually 5th. It depends on the technology as to whether you get away for things. It's almost like everything comes back to football. Jimmy Johnson saying if the rookie falls asleep in the meeting, he gets cut. If Troy Aikman falls asleep in the meeting, the quarterback, you just kind of give him a nudge and say, wake up. Or you let them take a nap, that sort of thing. So those are some things that apply here. Is data security is number 1. It's got to be secure. We can't put the company at risk for this technology. But the ROI case, whether or not we go forward, it depends on what the situation is for that. And finally, you got to keep it simple. This ease of implementation was ranked by 75% of retailers as important or critical there. And that kind of leads to this reality check. There, only 34% of the retailers think that vendors really understand what their challenges are. There's a big disconnect for things, and so when you look at that, and those people that rely on partners and vendors for tech guidance, they're 67% more likely to disagree that technology delivers quick ROI, but they're actually look at things higher long term, that it's actually they get higher ROI by using partners. It's a really interesting thing. It takes longer, but we get more out of it. Whereas the early adopters, we may not get as much out of it, but we get it earlier, and thus move on to new things. So the new technology concerns that people are most concerned about: technology reliability and downtime, integration with systems, the privacy stuff we talked about, the maintenance, etc. You can see this, you can read this in the report itself. So I want to get to some Q&A with that. 81% of the retailers put store association adoption speed, big thing at the store level. And it's about 50-50 on whether or not staff accept new technology as well.
All right, Greg, this one's for you right off the bat. What are the top 5 technologies that vendors or service providers should be focused on for their clients?
Well, I think the biggest impact ones, I mean, you've got, obviously you can't do anything without AI right now, or AI impact related to things, but that's more nebulous and it stretches across so many technologies. With the exception of that, I'd say the RFID and computer vision are number one, the IoT sensors and the management of that and the network associated with things there. And then I'd say the fifth one right now is probably, and I'm thinking hardware, is like shelf labels, being a big one with this particular market, with so many of them being grocery stores. If I was thinking about it software related, it's all loss prevention related, analytics, and inventory. Those are the big ones, at least at the store level, that are driving things.
Andy, this one's for you. What are your clients asking you for as they look forward?
Yeah, I think, great question, Lee. And obviously, as Craig mentioned, AI is going to be in the center of that, right? AI is in the center of everything these days, with retailers trying to understand what's real out there. When we went back a year or two ago, there were so many, companies claiming that AI can solve everything. And now retailers are realizing that's not true. So helping them sort through the noise and figure out what is achievable and what can be done. I think beyond that, though, Greg hit a little bit on RFID and computer vision, in the survey, and the great results we're seeing there. And I think that's absolutely playing a role. And then taking all of that and tying it together with AI as well. I think, AI on top of computer vision is starting to change the game when it comes to not just loss prevention, but also helping out with that store efficiency, helping out with improving the customer experiences. And we're seeing so many ways that all the technologies are being brought together.
Okay. Greg, what kind of impact is SALT 2026 going to have on retail?
Well, as I mentioned earlier, I think it's going to be found money for a lot of consumers that they're not necessarily planning on right now. If I think the SALT cap, the state and local tax cap, is $40,000 that you can get a deduction on. For most of those incomes, that would probably put them in the 25 to 30% tax bracket, depending on where they are. So they get that back. So you're looking at anywhere from $2,500 to $10,000 in your pockets to spend at that point in time. So that's going to be a huge boon to things. And if interest rates come down enough, a lot of that's going to go to hard goods, and people upgrading refrigerators and electronics and things like that. Sure.
Andy, could you provide specific examples of AI use that your clients are looking for?
Yeah, surely. I think there's so many great examples of what's actually being done right now. One in particular that is really resonating with a lot of our clients is we have a large client who's implemented a similar solution. And really what they're doing is taking their chatbots and language models and really extending that out to their store associates using voice. So, we have a client who has a very complex data set, or I'm sorry, complex set, I should say, to understand what products they have, answer questions for their consumers. And what we're seeing is they were able to leverage an AI model by ingesting their product database and all their product information that many retailers already have on hand, based off of their e-commerce side of their business. And instead of a store associate, when they get asked a question, instead of having to go over to a computer or take out a mobile device, very simply tap their ear or tap a button, the voice, and they're able to ask a question of the model. And they're able to find out what product, maybe an add-on product or a replacement part. They're able to find out, is it in stock, what the price is, where is it in the store? And having this ability to, on the fly, interact with their AI language model using voice is changing the efficiency of how they're able to operate with their consumers. It's also, by the way, in decreasing their need of training time when they're on, because now they have the ability to actually have access to that information easy.
Well, Greg, this one's for you, and this harkens back to that IBM commercial back about 15 years ago. When can I go to the store and just bag my stuff and leave without having to stand in line at the checkout?
Well, you can answer that one. You can do that at Sam's now.
Yeah, Sam's is close. I mean, it's pretty impressive, the technology they've got with Scan and Go.
You can do that at my Sam's now.
Outstanding.
Yeah.
Yeah, and I think you're going to see more
Just
and
make
more
sure
of that.
make sure you turn all your UPC codes up.
Yeah, I think you're going to see more and more of that, especially, in the soft goods space, right? It's a little more complicated when you get into the grocery space because all the interference and metals and liquids.
Right. Right. This is all being done by computer vision with SAMs today, not RFID, but certainly RFID for checkout. That's part of our next study, which is seeing some really strong interest and adoption there.
Good stuff. Good stuff. So one of the questions was, do the credit card purchases that you referenced in the data, does that reflect a continued move to non-cash purchases?
Yeah, that includes Apple Pay and other things there because it's a card on file. That transaction is coming through the bank. So they're reading the bank data, not necessarily the tender data at the retailer per se. They're getting those credit card receipts aggregated that have the items in the store locations and that sort of thing.
Yeah, data point for that, 55% decline in the use of cash in the last 8 years here in the States.
Wow. I bet most of that, though, was COVID related,
Yeah, that was. Here's a question for both of you. What's the end game when even more government spending is going to paying, interest payments than it is for everything else?
Listen to the All In podcast. I don't want to go into all the politics stuff there. I mean, that's why we have tariffs. That's the attempt to kind of offset some of that stuff, but we're paying for it. And then, like I said, we have all the negative news now.
Yeah.
So at least we got the salt thing coming next year and to look forward to.
And I would just say that it just stresses the importance of us being able to help the retail industry do more with less, right? And get more out of their investments and invest wisely. And I think that's just stresses the importance of what we're talking about today.
Yeah. Anything else, Lee, other than in the chat that they think you're on Vista?
At least to give them credit for upgrading from 98.
Yeah.
Boy. Well, that's all I got here, guys. We're about 4 minutes after the hour.
All right. Super. Hey, guys. Last but not least, if you go to NRF, would love to have you at Super Saturday to participate with Retail ROI Super Saturday. We've helped over 360,000 children by using our skill sets to make a difference. Our keynote charity speaker will blow your mind this year. Just the challenge she's been through, and she's actually in the industry herself. She works for Shopify, but what she's had to go through her own life and now what she's doing today is pretty extraordinary for that. But yeah, we'd love to have you and be a part of that. With that, we thank you guys. Thanks so much for being here, taking time of your day. Have a great weekend. Go Bucks. I saw Mike's a big Team Up North fan there. Go Bucks, and hope you guys have a great weekend. Thanks for joining us. Our next one will have some more information on that Windows 11 adoption, and specifically we'll be doing that on October 9th. Will be our next webinar. You can be a part of that one. So thanks so much.
Take care, guys.
Take it easy.
Windows 98.